Hi all. In today's video, we break down defensive and cyclical stocks, what they are, and how they perform in different market conditions. The market can be complicated, especially when you encounter terms like defensive and cyclical stocks. Let's establish what they are and how we can use them to our advantage. For those new to the channel, why not check out all our other videos that summarize other complex topics? And for those who want to take a step further, you can access my ebook developed from over 30 years of experience, join our forums, see my personal trades and access my bespoke scanner. Let's get back to the video. As you know, markets are constantly changing. In this monthly chart of the S&P 500, there were periods when stocks soared, like during the dot-com boom or the COVID bull market. Then there were times when stocks plunged, such as the subprime crisis or the COVID crash. And sometimes the market simply stagnated, with most stocks going nowhere. Most market cycles are closely tied to economic cycles. When the economy thrives, the markets typically follow suit, as seen during the period leading up to the subprime crisis. Because markets are forward-looking, they often perform well in anticipation of future economic growth, sometimes months in advance. Conversely, markets can also signal a downturn, often declining before the economy itself shows signs of weakness. Understanding the forward-looking nature of the market is necessary because the economic data generally comes with a lag, and the markets react in real time, anticipating what the data might look like. That's also why the markets sometimes decline on slowdown or recession scares that don't materialize. Therefore, as an investor or trader, it's essential to first identify the market's phase using market data and your trades, and then choose stocks that are most likely to reward your trades or investments. The first type of stocks we're discussing today are defensive stocks. As the name suggests, these stocks offer a defense against sharp market downturns, thanks to the resilience of the businesses behind them. Defensive companies provide essential goods and services, products people rely on regardless of economic conditions. Think of sectors like consumer staples, healthcare, and utilities. Whether the economy is booming or struggling, people will still brush their teeth, shave, take medicine, use electricity, and stay connected with their phones. Because of their steady demand, defensive stocks tend to hold their ground or even perform well during economic and market downturns. Moreover, these stocks are typically stable, low-volatility performers over the long term. They benefit from consistent consumer demand during both good and bad economic times, making them reliable investments in various market conditions. On the other hand, cyclical stocks thrive on economic momentum. The businesses behind these stocks cater to discretionary spending, which tends to increase during periods of economic growth. Sectors such as luxury cars, vacations, real estate, and jewelry typically do well when consumers have higher incomes and feel financially secure. In booming economies, people are more likely to splurge on these discretionary items, driving growth for cyclical stocks. However, during economic downturns, spending on these non-essential goods often declines, making these stocks more sensitive to economic shifts. While both cyclical and defensive stocks have their place, most trading returns are made in bull markets by trading cyclical stocks. This is when big moves happen, as investors chase and bid up stocks in growth-oriented sectors. Defensive stocks, on the other hand, are slow movers even when conditions favor them. There's no guarantees these stocks will rise during a market correction, and the best you can usually expect is for defensives to fall less than the broader market. They function more like a safety net. For instance, during the 2021 correction, the Nasdaq 100 fell 38% peak to trough. The S&P 500 dropped 27%. The DJIA Consumer Goods Index fell by a smaller 10%, and the iShares US Consumer Staples ETF, IYK, declined by just 5.5%. Notably, some stocks within IYK, such as Cencora Inc., gained 40% during the same period. Other fast-growing defensive names also outperformed due to business-specific tailwinds. When trading defensives, avoid slow-growth established companies. Instead, look for smaller defensive names with strong company-specific catalysts. For example, an established FMCG company may struggle to grow when consumers cut spending. An innovative, niche FMCG with a standout product might still expand by gaining new customers or entering new markets. This approach offers safety with growth potential, allowing you to benefit from the stock's defensive characteristics and the company's growth story. Markets give clear signals on when it's time for defensives or cyclicals. Bear markets and corrections. Cyclicals typically fall sharply on high volumes during down days and struggle to rise on up days. Defensives tend to fall less on down days and outperform on up days. Defensive leaders often hit new highs during market turbulence, can be identified quantitatively using relative strength or RS. Relative strength or RS compares a stock's performance to a benchmark index. For example, an RS of 90 on a yearly basis means the stock outperformed 90% of the market over the past year. Analyzing changes in RS can help you to spot emerging leaders and to identify fading sectors to avoid. Transitions between cyclical and defensive phases don't happen overnight. It usually takes a few weeks to confirm a market turn. Avoid relying on pundits and economists to time your strategy shifts. Their predictions are often wrong, and while they face no consequences, you might. Instead, trust market data, chart patterns and stock sector behavior, and your trades. If failure rates increase, it's a sign to pivot. For long-only traders, strong defensive stocks offer the best refuge during market turbulence. Look for stocks showing resilience in down markets and reduced position sizes to manage risk effectively. For those comfortable with shorting, down markets provide opportunities to short cyclical stocks, potentially bypassing defensives altogether. Regardless of your trading style or market phase, risk management is supreme. Even with defensive stocks, set objective stop losses and stick to them. Exit immediately if your stop is hit. This rule is non-negotiable and applies to all forms of trading. By listening to the markets, adjusting your trading plan and managing risk effectively, you will be well positioned to navigate any market environment. Thanks for watching.